Well, good morning, everyone. Great to have you here. Nice to see everyone. Okay, so we've got, everyone can hear me okay? We're good, thumbs up? Okay, that's wonderful. So thank you very much for taking the time to be with us today. My name is Barbara Da Fonseca, in case we haven't met before. I'm the principal of the firm. Thank you so much for taking the time to be with us here today. And joining me today, you can either see him, in the, you'll see on the next slide here. I'll just do this and I'll switch slides so you can see. Okay, one moment. Okay. Yeah, that's not working. Oh, there we go. Okay. Paul McVean, he's a member of our team. He is a chartered professional accountant as well, and a certified financial planner, a trust and estate practitioner, and he'll be going through lots of the slides with us today, which will be great. And the agenda for today, we'll be going through, what's new in terms of tax credits and deductions. There's some that already existed before, but the rules have changed slightly for them. A lot of subsidies that people have been receiving are being phased out. We'll take a little bit of time to discuss medical expenses, investments in cryptocurrencies, which is lots going on with those these days, RRSPs, and of course the home office deductions again this year. We'll then take some time to talk about 2022 and some tax planning, and then some other administrative items. Now, before we get too deep into the presentation, I do want to remind you that the topic is for 2021 personal tax tips. And of course, we'll do a little bit extra as usual. But I do hope that, when the tax season is over, or perhaps even before, that you perhaps give us a call to talk about some of our financial planning and estate planning services that we do provide here at the firm. Too many times we see families paying too much tax because they didn't take some time to plan in advance. And unfortunately, at time of death, hundreds and thousands of dollars can go, unfortunately, to the government instead of staying within the family's pockets. So please keep in mind that we have services here to help you plan proactively in terms of your taxes. Some housekeeping items during the presentation. Well, before we get started, if you do have a question, feel free to post it in the chat box, which is located on the Zoom menu bar. There's a chat box, and you can select it and you can type your question. And while we go through the presentation, and then at the end of the presentation, we will be going through those questions. If you could please mute all your microphones during the presentation, that would be greatly appreciated. And the presentation is being recorded so that we can send it out afterwards. Perhaps you might want to re-listen to it. And for those that couldn't make it today, we're going to share it with them. And also don't forget to stay till the end of the presentation. We are going to be giving out some free prizes. We've got some nice BDCA polo golf shirts that have come in to prepare you for the golf season in spring. And yes, without further ado, I'm going to let Paul McVean take over and start with the first topic, what's new? Okay, just give me one moment here. Looks like, unsurprisingly, in this day and age, we're having a little bit of technical difficulty. Just one moment, please. Well, what I'll do while Paul is having his connection fixed, I will start with the first slide. If everyone can please mute their microphones. Okay, thank you very much. Okay, so what's new? Well, for those of you that are receiving T4s today, or this year rather, for 2021, you'll see that all the extra boxes that were provided previously, boxes 57 through 60. Natalie, can you please send Paul the exact details, if that's okay?
Yep.
Thank you. Okay. Looks like his link's not working. Boxes 57 through 60, which were the extra boxes that existed last year, are no longer there. Looks like the CRA is not trying to track and see if some people were double dipping. If you can see on the slide there was 4 specific boxes that were included to track and report your income that was earned during those specific periods. So if taxpayers made a little too much and still also went and applied and received, for example, the CERB, that was their way of tracking and seeing who was double dipping and getting the funds returned to them. So those boxes are no longer existing. In terms of that PD27, if you're a sole proprietor also pay taxes, that PD27 form that had to be reported last year no longer has to be reported this year, which is great, especially for those of you preparing those payroll forms. I can see Lisa Lamb right now, and she prepared a lot of them. So we don't have to worry about those this year. T4As, just like last year, if you received a T4A, it reported also CERB on there and some other forms of income. In 2021, there was new programs that were offered in the form of subsidies, and those are also going to be reported on a T4A. However, that's all fine and dandy, but please do remember there's that $38,000 clawback. If you earn greater than $38,000, you will have to start to repay some of that back to the government. I believe it's 50 cents for each additional dollar. So just beware of that. That rule was enacted last year and it's there again. Now, some of you received some of the funding and realized that you shouldn't have. For example, the CERB, it was pretty easy to apply for it. And you got it quite quickly and easily. And then you realized that you shouldn't have. So you went and repaid it. What the government is saying is, if you have repaid it, you have the option to deduct it in 2021, as well as, if we could mute the microphones. Okay. As well as have the option to deduct it in 2022. Sole proprietors and also any non-sole proprietors that received CEBA loans during 2021, you might have received 4,000 or you might have received 50,000. CRA has extended the deadline to December 31st, 2023. Originally, it was December 31st, 2022. A friendly reminder, if you did receive that loan, the forgivable portion will be in the year of receipt. So if you have our personal tax checklist this year already, you'll see that we're asking you to advise us if you did receive the loan, because unfortunately we've got a tax lien last year. And there's just some details for you. Loan forgiveness up to the value of the loan, the maximum of $20,000 if you receive $50,000. And you have until December 31st, 2025 with interest at 5% on January 1st, 2024 if you do not pay it all right away on January 1st, 2023. Nothing new, unfortunately, in terms of telephone wait time for the CRA. They're still too long. However, they have started an automated callback service, which is helpful. We've noted here on the slide for you, if you're a business, or just for the personal tax benefit, you can call that specific number. And once the wait time reaches a specific amount of time, they will advise for a callback option. Okay, and you can also register for CRA's My Account. Great. Okay, and what else is new? Recently we're seeing a lot of vehicle expense audits happening, and the CRA is asking for mileage. So please be prepared to show some, quite a few occur already. And still, the CRA is still quite interested in foreign tax credit, donations, and medical expenses. So it's very important that you keep all of your backup. There are full audits that are occurring where they're quite extensive and there's all the backup involved, or there are reviews that are occurring where they simply want to verify certain information. This year, the climate action incentive credit is being treated differently. Previously, you received on your personal tax return the fundable credit right away. Now, you will receive it quarterly, just like the GST credit or the Ontario Trillium benefit, which is paid out to you separately. Finally, payments greater than $10,000 must be made electronically. No more checks. All more than $10,000, you do have to make payments electronically. Okay. So during the year, Bill C8 was put into place. And quite a few refundable tax credits are proposed. The key thing to keep in mind is that it has not been enacted. However, our tax software allows us to accumulate the information from you and to deduct it on the return. However, it has not been enacted. So we're going to have to be very careful. Two things that come to mind for this group here is the return of fuel charge proceeds to farmers tax credit. We do have a handful of farmer clients, as well as teachers, the eligible educator school supply tax credit. Okay, so that's something to keep in mind. If you've heard about it and you're all ready to get it and receive that credit, it hasn't been enacted yet. We're still waiting. So we'll see. Perhaps it'll be for 2022 taxes or 2021, but our software is ready to go and able to handle it. And finally, that new COVID home office deduction. Last year, it was a maximum of $400. This year, it's a maximum of $500. And we have some separate slides to go through that a little bit later. Okay, we have the reminder about the digital news subscription credit. Not too many people took advantage of it. It came into legislation the prior year, and it's for qualified Canadian journalism organizations for digital news subscriptions that do not hold a broadcasting license. And I can show you, there is a wonderful and handy, if you wonder if you qualify for this, there's a wonderful link on CRA's site, which you can see right here, where you can actually type in a specific subscription and see if it qualifies. So if you are uncertain, there's a wonderful listing that you can search through. Okay, it's quite lengthy, and you can go through that and see if yours qualifies so that you don't miss out on that credit. Whoops. Okay. And another thing that we wanted to bring up today is your homes, your cottages. Quite a few people disposed of them during 2021. Quite a few of you called us to advise us, which is great, and we've had some discussions. We just wanted to remind you, as you gather your details, to remember, many people have more than one property and both can qualify as a principal residence. There's an ordinarily inhabited rule, which is actually quite easy to meet the conditions so that your cottage, for example, even if you only stayed there, 2 weeks per year, could qualify. So very important to send us all of your records, renovations, any cost that you put into that home, the legals on dispositions, the realtor fees, your renovations, significant costs, new kitchen cabinets, new bathroom, all of that adds to your cost and reduces the capital gain. So please keep that in mind when you are gathering your documentation for us. And I think at this point, I'm going to let Paul join in. And Paul, I let the team know that we're having a little bit of technical difficulty, which is not uncommon these days. I was actually going to do this presentation from home, but lately in Richmond Hill, Rogers Wi-Fi has not been so good. So I came to the office to have it last minute. So I'll let you take over, Paul.
Sure. Thanks, Barbara. And hello, everybody. My apologies for my late arrival today. I've been trying to get in for the last 20 minutes. It finally worked. So good morning to everybody. Thanks for being here. Just so I'm caught up, Barbara, you've covered through home and cottage dispositions?
Yep.
Okay. So moving on from there, the Canada Workers Benefit. This is something that low-income earners may qualify for. There have been some changes to the thresholds, and there's a new secondary earner exemption that has been introduced that allow the second member of a household to ignore a portion of their earnings as a way to potentially qualify for more significant benefits here. Most of our clients, I would not expect to qualify for this, but if you're an individual or in a household with low income for the year, this may be something that comes up for you. In 2020, due to COVID, or I guess for 2020 returns, I should say, in 2021, CRA allowed people to avoid paying interest on late filing and late paying of their personal tax returns. That was only for last year. So that rule has now gone away. There's some subsidies that are being phased out that relate to COVID benefits, the Canada Workers Lockdown Benefit, the Canada Recovery Sickness Benefit, Canada Recovery Caregiving Benefit, and the Canada Recovery Benefit are either gone or going away by early May this year. There are details you can see at that link that is provided at the bottom of the page. So moving on, looking at personal tax returns and who has to file. There are certain conditions that arise that cause people to be legally obliged to file returns. And these include if you have taxes payable upon filing. If you owe the government money, then you are required to file a return. If you're entitled to the Canada Child Benefit, if you've received the Canada's Workers Benefit, you have to file your returns so the government can keep track of those benefits and your earnings to know what you're entitled to. If you've disposed of capital property or had a capital gain in the year, you're required to file. If you have to repay any of your OAS or EI benefits, if you've not paid or repaid all of your home buyer's plan or lifelong learning plan, you need to file. If you have self-employment net income greater than $3,500 and you owe CPP, you need to file as well. If you've left Canada for tax purposes, you need to file a return. When you leave Canada, you're deemed to dispose of your assets, and Canada wants to get their share of tax on the growth before you leave. So you're required to report that information in the year that you leave and become tax resident elsewhere. If CRA has sent you a demand to file, then you're required to comply, even if you don't otherwise owe anything. If you've elected to split pension income in retirement, or if you elect to pay EI and self-employment earnings. These are all conditions that require you to have to file a return. If you don't have to file, there may be reasons that you still want to. There's still benefits to doing so. If you've overpaid your income taxes, then you want to file to be able to get your tax refund. Sometimes we hear from clients how happy they are that they're getting large refunds, which is great in the moment. It just means that the government took more than they needed to over the course of the year, though. So certainly if the government owes you, we want to get your returns completed and filed as quickly as possible to get those dollars back into your hands. If you are receiving certain government benefits that are income dependent, then you want to make sure you file to keep those benefits in place. And also filing will cause you to generate RSP room if you have earned income, and also to generate new TFSA room. You need to file returns to be able to pick that up. Okay, one of the topics we wanted to touch on that is something that is very common across many of our clients is the issue of medical expenses. Medical expenses have some special rules that we just want to review and give you some information on where you can research certain expenses to see what qualifies. So first of all, there's a condition that it must be paid. You have to have actually incurred the cost and paid out of pocket for a expense. But for medical expenses, because we have to surpass a threshold, which is the lesser of 3% of your net income, or an amount that's set by the government each year, which I think is in the range of $2,300, you have to exceed that amount. So one of the rules that is in place that allows us to potentially have you exceed that amount is that we can claim any 12-month period of medical expenses that ends in 2021. So we can look at any 12-month period that falls into, that ends in 2021 to look at how you may maximize your medical expense claim. If you essentially incur your medical expenses fairly evenly over the course of each month, then really there probably wouldn't be any particular win to looking outside of a calendar year period. So for the most part, we file on a calendar year basis. But if you incur some significant lump sum costs, and we can group them into a 12-month period, but not necessarily on a calendar year basis, that may allow you to claim more of those expenses as a credit. Medical expenses can include payments that are incurred outside of Canada. Travel insurance premiums, the medical portion of travel insurance, and the actual expenses themselves can be incurred outside of Canada and still qualify. For COVID, mandatory COVID tests are deductible if accompanied by a prescription. So if you've had to pay for COVID tests and you have a prescription to have done so, then the cost of that test may be added to your claim. Otherwise, any costs of COVID tests that were optional or not accompanied by a prescription would not qualify. For those who qualify for the disability tax credit and receive attendant care in a facility or through a caregiver, there are rules that say you can either claim the disability tax credit and up to $10,000 of attendant care costs as medical expenses, or you can choose to forego the disability tax credit and claim all of your attendant care costs. That's typically something that we look at for you on your behalf. But just so you understand, the disability tax credit is essentially about a $7,000 credit, give or take. So if your attendant care costs exceed that $17,000 mark, then likely we would forego the disability tax credit claim on your tax return and claim the attendant care costs if that results in a greater benefit for you. Because medical expenses sometimes can be sensitive in nature and you want to look up whether or not something qualifies yourself, we've provided that link. And Barbara, do you just want to speak to the website here for a second?
Sure, yeah. So the link is in the presentation that we sent to you, everyone. However, this you'll see here the list of common medical expenses, and there's even further information in this little income tax folio here for you also. But I just want to show you, you know, you can show 100 entries at one time. And this is a great handy chart when you're sifting through your receipts to see what is eligible or not, whether or not you need a prescription for this item to be eligible. Does it have to be in writing? And form T2200 is the disability tax credit form, whether you have to qualify for that in order to be able to deduct something. So this is a wonderful chart that we encourage you to use. And for example, you know, I'm just going to type in here. I've heard, for example, tutors. A tutor can be deductible. Lo and behold, I type TUTO, tutoring services, show up. And they are eligible. You don't need a prescription. Certification writing, yes. And you just click on the link there and it gives you some more information. So if someone has a learning disability or an impairment in mental functions, then they can have tutoring services used as a medical expense on their personal tax return. So it's a very handy and useful link and service that the CRA provides. And again, it's listed in the presentation for you. Okay. And there we are.
Okay, moving on to the next slide. This is a topic that has become very relevant for us in the last couple of years. Investments in cryptocurrency. So first of all, with investments, one of the things that is a bit tricky is the sorry, I've just started getting an echo. Is anyone else hearing the echoes or just me?
You're correct.
You're correct, Paul.
Someone has a mute. The mute all function is not working today, guys. Not an option for me.
Are we good now? No, I'm still getting an echo. There. Is that better?
Yes. Yeah.
Okay, perfect. Okay, thanks. Okay, currency considerations for investments. We have to think about investments that are not denominated in Canadian dollars sometimes, and we need to know how to convert the income and capital gains that result from holding those investments. Where income is earned over a period of time and it's paid out on a somewhat regular basis, we typically are able to convert the foreign income into Canadian dollar terms using the average foreign exchange rate for the year that CRA provides to us. But where you buy investments in foreign currency and sell them, we need to convert the purchase of any of those investments at the historical exchange rate on the settlement date of purchase, and then convert the proceeds of disposition at the foreign exchange rate in effect on the settlement date of the sale. So we can't simply convert foreign capital gains into Canadian capital gains. We have to convert the adjusted cost base at the historical rate and the proceeds of disposition at the current rate to then calculate a Canadian capital gain or loss. So because of currency fluctuations, the Canadian capital gain or loss may look significantly different than the capital gain or loss as calculated in the original currency of the investment itself. So just something to keep in mind if you are holding investments denominated in currency other than Canadian. Talking about crypto currency, technically, crypto assets are not considered a currency in the traditional sense by CRA. Really, crypto is considered a commodity from a tax perspective. So the activity that is carried on using cryptocurrency may trigger a tax impact of sorts. So triggers what causes you to perhaps have a taxable event to report on your personal tax return. If you sell or gift crypto to anybody, if you trade or exchange crypto for other crypto or for actual currency, if you convert to currency or if you use it to make purchases, or if you carry on the activity of mining and gain cryptocurrency, all of those would result in a tax impact. One of the big questions when it comes to crypto is whether you have a capital gain or business income. And that really depends on the underlying activity that you carry on. For example, if you're mining crypto, you're effectively carrying on a business, or at least from a CRA standpoint, they refer to that as an adventure in the nature of trade. So even if it's a one-time activity, and not being carried on over and over again, it still could be classified as business income, which is fully taxable. But then with business income, you're allowed to claim certain expenses if you've incurred them for the purposes of earning that income. If you're carrying on a business and just happen to use crypto as your medium of exchange, and you're holding crypto sort of incidentally, but the main purpose is to carry on other activities, then the gains or losses you make on the crypto may be capital gain in nature, capital gains or losses accordingly. This can be a very complex area of tax. So certainly if you have any of this activity going on, we would want to learn as much about what's happening from you as possible, so we can then determine the appropriate tax treatment. There's a guide that the government has put out for those who use cryptocurrency that would be helpful in describing some of these circumstances and giving you some understanding, but also feel free just to come to us for further explanation. Okay, now talking about RSPs, something that we see every year is that people may over contribute to their RSPs. Sometimes they do this by misinterpreting the notices of assessment. So it's important to understand the information that you're receiving that tells you what your RSP space is available for the future year. And if you are carrying forward any unused contributions from a previous year, then it may impact how much you're able to contribute. Coming into 2022, based on your 2021 income, the most you can add to your limit is $29,210. That's based on 18% of your earned income up to that threshold. So make sure you understand what your RSP contribution limits are, so that you don't get into an over contribution position. If you do over contribute, there's a mandatory self-reporting process using form T1 OVP. There's a 1% over contribution penalty that applies to over contributions in excess of a $2,000 cushion. The T1 OVP calculates what that penalty is, and you need to report that on a calendar year basis if you've been in an over contribution position at any point in that previous calendar year. T1 OVPs are due by the end of March each year for the prior tax year. So it's good for us to understand if you need to file something like this ahead of time, so we can get it turned around before the end of March if possible. And the other big decision around RSPs is when you do make contributions, not everyone knows this, but it's optional whether you claim the full amount in that year or not. So when you've made a contribution, when we look at your tax return, we might look and say, hey, if you don't claim everything this year, you might get a bigger savings by holding on to some of that for a deduction in the following year, if your income might be taxed at a higher rate in the next year or two. So something to keep in mind is, even though you've made the contribution, you don't necessarily have to claim the deduction right away. It may make sense to stagger that over 2 or more years in order to maximize the actual tax savings that the contribution provides. And with that, I'll turn it back over to you, Barbara.
Okay, thank you so much, Paul. So home office, here we go. We're going to recap the home office expenses for you. They're quite different the last year or so, and they still exist. So we're just going to start off by saying, there was the as per usual way, where those that were required pre-COVID time to work from home and still continuing on into COVID time to work from home were able to claim some home office and other employment expenses. That way of claiming home office and employment expenses still applies to those individuals. But there was the COVID way, the new way, where 2 new methods were introduced to taxpayers, Canadian taxpayers. Again, this is called the temporary flat rate method, aka the simplified method, because it is much simpler, and then the detailed method. So the temporary flat rate method is $2 a day again. However, now the CRA has says, we'll let you have 250 days at $2 a day. So it's $500 is the deduction that you'll allowed, and it will reduce your taxable income. So for example, here, 20 business days for the month, that would work out to a $40 deduction. And we have a separate slide coming up next that will discuss what is an allowable workday. A reminder again, in order for you to qualify for this method and the more complicated detailed method, is you had to have been working from home due to COVID. So you were locked out of the building or your employer required you to work from home due to COVID. And you had to have worked from home at least 4 consecutive weeks during the year. And during those 4 consecutive weeks, at least half of the time had to be from home. So if you were allowed to go into the office 2 days a week, but you were forced to stay home 3 days a week, and that's for 4 consecutive weeks that occurred, that is more than 50%, and then you could qualify to use this $2 a day method or the more detailed complex method, which we'll discuss. What we like, or perhaps love about this method, is you don't have to worry about calculating square footage at home or wondering if your kitchen table qualifies as a home office because you validly use it as your home workspace. You don't have to keep receipts. You don't have to provide receipts. No one's going to ask to see those receipts. You don't have to ask your employer for a form to prove to the CRA that they required you to work from home. One other thing is, again, this $2 a day just pertains to your home office. So there's no other expenses. You can't also submit your telephone expense, for example. The $2 per day covers all that. And finally, if you and your spouse and your 2 kids that live at home with you that are also working all qualify for this $2 per day, all 4 of you on your each returns could claim the $500 deduction. Again, as long as you worked 250 days from home. If it was 200 days, then it would be $2 a day. And that'll take us into our next slide where we'll talk about what is an eligible workday. So as you can see there, and this is actually copied right from CRA's site, and it's actually easier to look at what you cannot count as a day. So any days off you took, vacation days, you might get paid for those vacation days by your employer and you might be entitled to them, but they don't qualify for this $2 a day home office deduction. 6 leave days or any other leaves of absences. Okay, so please keep that in mind. Again, you'll see in our personal tax checklist that we sent out to everyone, which will also be available on our website later this week. We ask you for how many days, and this is why we really need to know the number of days that you worked from home that qualify so that we can put the right amount on your return. Okay, so that's the simplified method. And now we have the detailed method. So again, same rules. You have to have worked from home for 4 consecutive weeks, at least 50% of the time during those weeks. You must have been required to work from home by your employer. Now, this one requires more efforts, not as simple. You must have a signed form from your employer. It's called a T2200S. If you received one last year, you'll know what I'm talking about. If not, just ask your employer. If they require you to work from home, then you are legally allowed to ask and obtain this from them, that you are entitled to that. So you ask for that form, you have to retain it in case of audit. And now you have to start doing some work here. It's not as simple. You need to calculate the square footage of your home workspace. You have to only consider finished areas. So an unfinished upstairs or basement wouldn't qualify. You have to include finished areas of your home. The amount must be reasonable. And there is a calculator to help you calculate this on CRA's website, or you can call us. But a couple of things to consider, does the dining room table qualify? Yes, it does. But again, the calculation gets even more complicated because this space is also used by you personally. So not only do you have to consider, the square footage, but you also have to take into consideration the number of hours that you worked at that dining room table and how many hours there are in a week, and do a further calculation. So sometimes when you go through all the details, you might have 10% of the dining room table might consist 10% of the, whole home square footage. But then if you're only there 2 days a week, 24 hours a day, 48 hours, divided by 168 hours is for the full week, that percentage gets so small, and you add up all of your expenses that you can claim, and it probably is not worth your while to go through that effort. So, but I mean, it's up to you, of course. So we've got the dining room table that, yes, it can qualify. And then we also have what's called as designated space. So it's a separate office that you do not use for personal purposes. Okay, and we'll chat a little bit about those now also. So the shared workspace, we discussed that, and actually, it looks like I have gone through all of this already. And here's actually an example for you to see, a nice detailed example. When considering the type of workspace, here on the right side of the screen, you can see a designated room. Let's call it your spare bedroom that you have converted into a home office, and that's all you use. You do not have to worry about the number of hours that you worked in that room at all. So 100% of the expenses, the home expenses that pertain to the square footage of that spare bedroom will be deductible on your personal tax return, subject to a couple of qualifications, which we'll get into a little bit later. But now on the left side of the screen, there's the kitchen table example. That shows you, in this example, the individual has worked at that kitchen table 40 hours that week, and there's 168 hours in a week. That's 24 times 7. So that gets you to a percentage, and then that is the percentage of time that you can claim for the workspace. So a lot more calculations going on here. It's definitely more complicated. So again, if you've got a separate area, the spare bedroom that you converted into your home office, or a room that was built specifically to be a home office, you don't have to worry about the number of hours. Don't worry about that. But if you do share that home office with your spouse or your partner or your child, then you can only claim half on your return, and they will claim the other half. Okay, you do have to keep that in mind. And this is just another helpful example talking about the dining room table. Just set different numbers, but another helpful example. Everyone will be sent this presentation, and it will be available on our website. So you'll have these slides handy for you if you want to revisit and do some number crunching. Same thing again. Another great example for you. This is our second year into these rules, so I won't go through it in too much detail, but I did want to remind everyone, we did want to remind everyone of these. Okay, so we know that simple method, the $2 a day covers everything, which is great, nice and simple, we like it. But maybe you really are incurring a lot of expenses, especially maybe you rent your house, and that rent could be $3 grand a month, who knows, right? So we've got a nice list here for you if you choose to use the detailed method. Again, this is copied straight from CRI's website. It's a perfect little list. It's also on the form, our tax forms, and it shows you what you can include. So if you take a good look at that list, again, you'll get a copy of these slides, your utilities, home internet access fees. We'll discuss those a little bit more. Rent is a big one, and commissioned employees are entitled to a few more expenses, which are listed there: the home insurance, property taxes, and lease of some equipment. What cannot be claimed by anyone: mortgage interest, principal in your home, home internet connection fees, furniture, capital items. And look at that one, wall decorations. Keep that in mind, because I see art come through sometimes. Wall decorations cannot be claimed. Okay, that's specifically stated by the CRA. A few things, it gets a little tricky with these telephone, internet, and the CRA got quite detailed with condo fees the last couple of years. So you cannot claim your basic connection fee. You can claim your long distance calls. So technically, just like in the old days, highlight that bill, those expenses, those calls that are business related can be claimed. And you can claim employment use of a basic cell phone service. Internet, You can claim home internet access fees, but just remember, if you already had that internet access fee and there's no incremental increase and you're trying to now claim it, CRA could challenge it. You cannot claim portion of fees that relates to lease of a modem or router, and you cannot claim connection fees, okay? Now, condo fees, this is an interesting one. You can only claim the portion of your condo fees that relates to utilities. So now you say, well, how do I figure that out? The condo corp is supposed to send you a nice statement, and they might not get it to you in a timely basis. So the CRA says you can rely on last year's allocation if you haven't received this year's yet. Okay. So many details with personal taxes. The forms that were created during 2022 to claim the home office due to COVID, they still exist. It's called the T777S. That's a different form we have to complete for you. And again, that form T2200S, a new one the employers are supposed to complete. We mentioned before, they have to complete for you. It's very straightforward, short and simple. Your employer should be able to provide this to you quite easily. And here's a handy chart. We showed it last year also, what you can or can't do. And again, we do like the simplified method better. But again, if you have some substantial costs incurred, you might want to do both calculations to figure out what's best for you. Unfortunately, there's no, we can't say always use the temporary flat rate method. It'll benefit you the most always. Each person's circumstances is different. So we can't always just say, oh, use a detailed method. That's best for everyone. It truly is not. Each individual situation is unique. Okay, so if you've got the time, calculate using both methods and then choose. We can do it for you, but then it means more time spent on your tax returns, and we want to keep your costs down. So we try to keep our cost time down. So if you could help us help you, that would be wonderful. And please do remember, if your employer reimbursed you for these costs, you can't claim them. That's double dipping, so you can't claim them. And do remember that, for example, if you only work from home for half the year, then, you know, let's say from June till December, then you can't claim January through May's expenses. Okay, please keep that in mind. Home office expenses can only be deducted against the employment income. So if you had no employment income, you cannot qualify for this. If you had some employment income, but not enough to cover the home office, you cannot create a loss, but you can carry forward those home office expenses. And finally, commission employees are limited to the home office deduction that will be sufficient to reduce the commission's income to zero, but you can't create a loss from the commission using the home office. Okay, and as usual, everything must be reasonable in CRA's eyes. Back to Paul.
Thanks, Barbara. Just to wrap up a few more slides on some further tax topics. For 2022, these are the new top marginal rates on various sources of income across Canada. We've highlighted Ontario for you so you can see what applies here. Ordinary income refers to things like salary, RSP withdrawals, interest, foreign income, things along those lines. Capital gains come from buying something and selling it for more than what you paid, and there's a 50% inclusion rate, meaning half of that gain is subject to tax. So the tax rate on capital gains is half of the ordinary rate. And then Canadian dividends get their own special treatment because the companies that pay the dividends have already paid some corporate tax to CRA along the way. So eligible dividends come from Canadian public companies or private companies that have paid tax at the normal business rate. Non-eligible dividends come from Canadian private corporations that pay tax at the low small business deduction rate. And then specifically for Ontario, this chart just outlines all of the marginal rates that are in effect. The brackets are changing based on where the federal and provincial governments have set various thresholds. And you can see the rates range from 20.05% at the low end, all the way up to 53.53% at the high end. And we've just provided what tax rates apply on the various sources of income, depending on where you fall within the marginal bracket system. A few tips for 2022. Capital gain rates have stayed the same. There's been a lot of speculation over the last, say, 4 or 5 years that capital gain taxes may increase. And the most common version of that is that the inclusion rate may increase from 50% to something higher. The speculation that is most common is that the inclusion rate might move from 50% to 75%, meaning 75% of the gain is included in income, which may cause taxes to go up fairly considerably on capital gains. We thought we might hear an announcement on that this past year, and we didn't. The next budget may bring a change in that regard, but we're really not sure. What does all of that mean? Well, if you're very concerned that capital gain tax rates may increase, you may consider selling the assets that have those unrealized gains before any rate change occurs. If you do that, you might be triggering tax long before it's otherwise necessary to pay if you weren't going to be selling that asset anytime soon, though. So it's a bit tricky to look at how to manage this uncertainty around the possible increase in capital gain tax rates. We do have some ideas and strategies that may work, especially for larger dollar situations. So if you are concerned, that would be something to reach out to us and we can talk about your situation and see if there are steps that we might want you to take to proactively manage that. Federal and provincial budgets will come out in March, April. We don't have exact dates for those yet, but they will announce any changes to our tax system. Every year we're on the edge of our seat waiting to hear what might come down the pipe. Given how much the government has spent in the last couple of years with COVID benefits and related things, generally we think taxes probably go up, not down, because the government needs a lot of money to pay for what they've been spending. One positive note for 2022, Ontario has introduced a staycation tax credit where 20% of amounts paid for a leisure stay of less than a month in the typical kind of vacation accommodations you might use, that can be claimed as a tax credit. There's a maximum claim of $1,000 for an individual or $2,000 for a family. Within a family, only one individual is allowed to make the claim. So you just would need to decide when we file next year who will report. But hold on to your receipts if you have any expenses at hotels, motels, resorts, lodges, bed and breakfast, cottages, or campgrounds. And the last point I'll touch on here is just the possibility of a wealth tax. This is something that is also being speculated upon, that as a way to raise more funds to pay for all the government spending, going after the most wealthy in Canada and applying some sort of tax based on the wealth rather than the income of individuals or corporations. That's a concept that possibly could come about. We've actually had this sort of a tax in the past at the corporate level in years gone by, but it has not been around in many years. But who knows, we may see this come back. Okay, and the last thing I'll talk about here is just installments. Because we are getting close to preparing your personal returns, we know that some of you may have installment requirements for future years. And the requirement to pay installments comes up if you have paid more than $3,000 in the current year and either of the previous two when you file your tax return. So when we prepare your return, our tax software will indicate, and CRA will then confirm with a notice if they are expecting installments going forward. If installments are due, they're due the 15th of the end of each quarter, so March, June, September, and December. if you pay installments, it's not a bad idea to mark in your calendar, perhaps a few days ahead of time, that installment payments are due so you don't forget. If the installment requirement is much higher than the taxes you think you'll end up actually owing in the following year, it's your option to reduce or eliminate what you pay to CRA. You're not going to be chased by their collections department if you do that. But if you have made insufficient payments, either paying late, paying low, or not at all, then interest is calculated from the date the payment was due to the time that you actually make payment based on the prescribed rate that's in effect. And if the installment interest for the year is greater than $1,000, there's also an installment penalty that can apply. So if you're in a situation where you're being asked to pay installments and you think that it's more than you want to be remitting, certainly you can feel free to speak to us and we can run some projections for 2022 if you know what your income might look like. And we can help you recalculate and determine if you should follow the installment schedule as outlined, or perhaps if you want to make lesser payments. If you end up owing more than what the installment requirement has asked for, you are not charged any installment interest. You're not obliged to send any more payments in than what CRA asks for when they issue the installment notice. And with that, I'm going to turn it back over to Barbara to finish up.
Okay, that's great. Thank you very much, Paul. And thanks everyone for your patience. For the life of me, the mute all button is nowhere to be found today. Perhaps I need to do a Zoom update, not certain, but again, thanks for your patience. So just a few more things. Our online platform is set up and ready for you to go to use. Natalie has created all the folders for you on there. And just a reminder that it's a very safe and secure online platform that we share your personal confidential documents on. Definitely safer than email, so we encourage you to use it. Again, the folders have been created for you. Just a friendly little note, PDFs are easier for us to use versus picture files. Picture files we find sometimes are uploaded sideways, or then we've got to convert them to PDF. It's not so easy to work with. So please, if PDFs could be uploaded, we'd greatly appreciate it. And sometimes I know we all have our great intentions and we're always in a rush. We always have too much to do or so much to do. But sometimes that you can't really see, or it's a little blurry, or you've taken the picture on your lap and the page is kind of crinkled and it's hard for us to see. So if you could please try your best to upload a nice clear document so that we can ensure not to miss anything on your tax return. And here's just a sample of what the folders look like. And so, for example, your multiple medical receipts, if you are using the system, you can put them into medical receipts folder, donations to the donation folders, our wonderful checklists that we've created, and we've updated them for you again. That would go into the first folder there with your tax slips. We have a nice README file, again, to help you if you need some assistance, or again, you can always call Natalie or one of the team members here. Team members, you can see on the Zoom session today, they have the virtual BDCA background for you. And I can show you, I've just pulled up the Excel version of the checklist. So you can see how quite easy it is to use here. And there's some, drop down boxes, yes, no, not applicable, to help you. The Excel version has these different tabs, to help you complete. It's quite handy. Here's that home office method, number of hours worked per week, highlighted there for you. Home workspace, some really handy information and tools for you to help you ensure that you don't forget anything. The automobile expense, if you use that for your self-employed business. A rental schedule, if you have if you're renting out perhaps your basement, or you have another property that you own personally that you want to report the income. So we've got that handy one there for you, as well as a PDF version. If you prefer PDF, we've got that there for you also. So for example, for the home office, do you want to use the $2 a day method or the detail method? Let's pretend it's the $2 a day method. Just click it, nice and simple for you, okay? Drop down options all here for you. So I just wanted to share that with you in case you haven't seen it before. Okay. Our checklists. And just a firm update, we've still been going here nonstop since COVID started. The building, as usual, has a 24-hour security. You still do need to have a pass card to get up through the elevators to come and visit us. We are on limited staff and rotation schedule here just to maintain safety. We know that the world is getting safer now, but we're just still being extra cautious, and we still wear our masks and do our social distancing here. Some of you may have missed, I know some have missed the couple of communications. One of them had advised that John Stewart had moved on. He's actually on the session here today. Hi, John. He's actually president of our client, amazing opportunity for him. We're so happy for him, and we still work with him just in a different capacity. So Wilson Wu, if you haven't met him, you can see him online, and he's joined us. Also, Brian Foe, Supervisor of Accounting Services. We felt we had the need for that position also. Jeannie Tran, a wonderful individual I've worked with for many years previously, has joined us in internal accounting and does a lot of helpful work with our clients also. And finally, we have, as we're an approved training office, we love to help out our students and our apprentice CPAs, our CPAs to be. So we have Victoria and Anthony that have joined the firm too. And all of these individuals have great personalities, diverse backgrounds and experience, and lots of knowledge. So we look forward to you meeting them and working with them one day also. In conclusion, as always, be prepared for CRA to ask questions and to have your receipts and backup ready. Keep all your detailed record. Plan for 2022 if you can, but also don't be shy. Come and visit us. Free consultation if you want to just talk about how we could help you minimize tax in the future, tax death, all that great stuff. And call us if you have any questions. Okay, so question and answer period. I'm just going to look here. I've received many, many messages telling me that there was an echo. So again, thank you for your patience. And let's see here. Is it possible that okay, most of these, if not all, are about muting the microphone and the echo. And so now, wait, let's see here. I have one retired client. Should I get a receipt from our stay in Mexico for next year? Richard, if this pertains to the Ontario staycation credit, then that wouldn't qualify because it has to be in Ontario. And I don't know, Paul, if you want to jump in, but the housing for outside of Ontario wouldn't qualify for that tax credit. But of course, those premiums for medical that you pay before you leave the country that cover you for medical expenses when you're outside, plus the medical expenses actually incurred outside of Canada, most definitely would be deductible on your personal tax return. And
nothing to add from my end, Barbara. That covers it.
Okay, great. And Susan, thank you for your question. Now, you don't have to use the online platform. You most definitely can come in and drop off the return. The doors are open at least 9 to 5, Monday through Friday. There's usually someone here at 8, sometimes 7:30. I'm an early bird. Sometimes I'm perhaps here a little too early. Sometimes people stay a little later. So if you come anytime between 9 to 5, for sure someone will be here. The doors on the weekend sometimes are open too. If you did want to drop off in the weekend, just let us know in advance. And so we can make sure that someone's here for you. Yeah, thanks, Susan. Thank you very much. I think I'll have to schedule a call with the creators of Zoom after to see what went wrong with the mute button. I've experienced over the years, always double check IT before you have your meeting. There's always something that can go wrong, right? Murphy's Law. Okay, we actually did have a couple of other ones that were resolved before the meeting, but anyways. Oh, okay, let's see. I think we have a few more coming through here. Last day to drop off your tax information. I hope that April 15th, everyone would get the tax information into us. It gets to be quite challenging when we have a major rush all at once right before the deadline. So we encourage you to bring them in sooner than later. If you're in a refund position also, that will mean that you'll get your refund sooner as well. And, you know, if you think about it, towards right as we get really close to the deadline, we're pushing through. We don't want to miss anything and have to say rush. You know, we've got quality control in place, and not one return leaves the store without having a second, more qualified eye, senior individual review your returns. But please, the sooner the better would be great. And I know that's very challenging. We know it's challenging because those T3 slips are only mailed out on March 31st, right? Or even a little bit later. So we'll work with you to do whatever we can. And Paul, I'm going to throw this one to you. Do couples that take advantage of splitting pension income have to continue to do so every year after? So
no, this is just really a question on each return itself. Each year, we look to optimize the splitting of pension income, and how it gets split can change year by year. You can split up to 50% of the higher earning spouse's pension income by passing it to the lower income spouse. And that may save tax because we reduce taxes of the higher earner at a higher marginal rate than we include the income at the lower earner level. But there's no requirement to continue doing that, or to what extent you continue doing that. So each year it's a clean slate.
Thank you. And we also have a question. If we have not claimed in previous years in medical for the travel insurance, how far back can you claim? Typically for personal tax returns, CRA will let you go back 10 years. However, I do warn you, be ready to have those receipts organized. They will ask to see them. Yeah. And so we have to have proof of payment. Again, medical expenses, that receipt needs to show that it's been paid. So if there's no evidence of payment, say, you know, paid via Visa or a stamp on there that says paid, CRA could deny it. So just make sure that all the backup you have shows that they have been paid.
And keep in mind that the cost of refiling old returns or amending old returns may exceed the benefit of claiming those expenses, unless you're doing that yourself.
Okay. BJ, I see your comment. Thank you. Yeah, very much. Maybe I'll connect with you afterwards. Okay. Thanks. Thank you very much. Okay, well, it's wonderful spending this time with everyone. Oh, let's draw a winner. Yes, Richard, thank you. Okay, so we're going to pass this over now to Natalie. We're going to have 5 golf shirts, hand those out. If you can see, I'm wearing one here. It's pretty spiffy, nice colors, and it's quite nice. It feels good, nice and light, good material. And we'll let her pick the names. We're going old school, out of a hat.
Yep. Out of a basket.
Hello,
everybody.
Okay.
Okay. All right. The first one I draw, let's see here, is Stephen Hurwitz.
Oh, wonderful.
Stephen, lucky number. All right. And let's see here. Out another one. And it is Carol Lipson.
Congratulations, Carol.
And, ooh, Hafizia Adatia.
Great, that's wonderful.
Okay. And let's see here. Duncan Skinner.
Great, that's wonderful.
And one more. Michael Jewson.
Great, wonderful. Congratulations,
All right.
Michael.
And that's it.
So Natalie,
I
you'll
will
reach out to
contact.
everyone? Yeah.
Yep, I will contact everyone and get you your shirts.
Okay.
Thank you.
Okay, thank you very much, everyone. Have a great day. Looking forward to seeing you soon. Bye-bye.
Say thank you.
Thank you.
Thank you.
Thank you.